the Gould Mine podcast.
So if single families are base hits, what are the multifamily projects that you invest in now?
Well, I'd say you could find base hits or home runs in any of this. So again, I go back to development, right? Development projects, right? Where somebody hasn't even broken ground and they show you a picture. Here's going to be an apartment complex or a hotel that's going to be built in 2.5 years. It'll be done. And we got to lease it up, stabilize it and sell it. So it's a 5-year project, for example. By its nature, that's a lot more risky, right? A lot of things can change. And we're seeing that in today's environment. A lot of development just started a couple of years ago when interest rates were quite low and demand for housing had surged. There's some difficulty, right? Because financing became a lot more expensive. Inputs, prices, and supply costs, labor, et cetera, went up. So I'm sure anybody can drive around and pretty soon you'll probably find some projects that are just sitting there not being done. So that's maybe a home run type, development, ground up development to be, sometimes you have entitlement, zoning, you have all kinds of things that need to happen. A lot of things can go wrong, a lot of execution risk, even heavy value add, right? If somebody buys a really distressed type property and has to put a whole lot of CapEx into it and probably change out the current tenant base, right? Those are heavy lift projects. A lot of things could go, counter to your plan, right? When you have to raise rents a lot, you have to put a lot of CapEx into it. So I think you can select in any model, whether it's your own money or through a syndication, projects that are more or less risky. So your appetite for risk, I think, is independent because I could find pretty conservative projects in syndications and I could find ones that are going to be higher risk, potential home run, but a lot of things can go wrong. So my point earlier about some people want to buy properties that cash flow right away a whole lot. I mean, maybe it's Detroit or Cleveland. I don't want to pick on these places, but you might, on paper, it might look like you're going to get really good cash flow. But again, there's sometimes the realities don't bear that out. And also these are cities that have lost a lot of population. So would you rather, invest in cities that are growing where you got a lot more future potential? Some of these cities losing people, there's going to be no appreciation. And anyway, my point is you can find, I think, depending on what your appetite for risk is, you can find anywhere along the spectrum. So I think I look at it as risk-adjusted returns, right? You want good returns, solid returns, but you want to also minimize your risk, right? And so for me, what's kind of worked there is kind of the typical Class B apartments. During COVID, none of them were tremendously impacted. It wasn't workforce housing, wasn't C, where, hourly workers had been laid off en masse and they couldn't make rent. So a lot of them were like salary type people, a little bit higher income. So didn't have really issues. So again, you have to kind of consider a lot of these things in terms of the risk return profile, right, of the project. And so I wouldn't say it's as much about whether it's your own purchase or syndication purchase, just the type of project that you're looking for, right? And each of them will have a different risk return profile, I would say.
Yeah, that's interesting. And actually risk adjusted returns, I really want to dive into that. And that's something that, I haven't really talked about with many sponsors on this show. And I think it's worth kind of diving into. Before we do that though, just to wrap up the single family to multifamily transition. At first, I thought you were going to say, well, I looked at multifamily as a better asset class, like maybe like instead of a single or a double, it's more like a triple, right? But now I'm hearing like maybe that's not the case. So I'm wondering like what inspired that change. If it wasn't like necessarily that the returns were going to be that much better, why diversify out of what was already working for you?
Yeah, thanks for re-asking the question. So I think it was the scalability, right? Again, I had about 20 rentals that I was managing. I didn't see myself getting to 40 or 50. And I still wanted to increase my passive income, right? By buying more properties, but I didn't see myself wanting to manage that much. It was becoming more active than I wanted, right? So for me, it was more a decision around how active or passive was the strategy. So if I can make similar returns through a group investment, a syndication, right, as I could myself, without all the work, that was appealing to me. Plus, I can then invest in maybe different asset classes more easily, different cities, different states. It's a way to diversify more easily, right? Versus when you buy it yourself, you really want to do a lot of due diligence, and it's hard to do that all over the country. So a couple of the reasons was the active passive kind of equation, and the ability to diversify and scale was there. So hopefully that better answered your question.
Yeah, kind of. I think I'm still a little confused because now you're investing into different opportunities now as a sponsor, right? Like as a GP. So now that you're kind of like looking at these other deals, and by the way, I know that it's not just multifamily, right? Like what other asset classes have you invested in as a GP?
Well, as an LP, as a limited partner, just putting money into deals.
Yeah.
Most of them are multifamily.
Sure.
But as I suggested, there's also some mobile home, self-storage, industrial, triple net lease. And in multifamily, much of it was purchased product with a couple, 2 or 3 development projects. So there's some diversity there, right? And this, again, was just as an LP putting my money in. And I've gotten involved as a GP in the last couple of years where I was investing with a group and I liked what they were doing. We formed a relationship and I joined their team and I'm a general partner on their team.
I see. And what product are you guys mostly focused on in that group? What asset class are you guys mostly focused on in that group?
Multifamily, small multifamily.
Okay.
So my business partners are in Greenville, South Carolina, which is just down the road here.
Yeah.
It's a really appealing market. It's really high growth, good economic base. It's right between Atlanta and Charlotte. So there's been a lot of great things happening in Greenville. So I like the market. So I started investing with these guys on some of their deals. I could see pretty quickly they knew what they were doing. All the projects are doing better than they projected. And
yeah.
So the market appeals to me. They're looking at 50 to 100 unit type multifamily. So I think there's more value to be found in South Carolina right now too. Seems like there's more projects that can pencil. I've looked here in North Carolina a lot also, but it's harder to find deals that are going to perform as well. So South Carolina, there's a bit more cash flow, a bit more opportunity. One of our partners is the property manager. So we have some vertical integration. He manages by and large most of the properties we're buying. So that takes a whole lot of risk off the table, right? So there's some differentiation. And these guys are very experienced. Our best investing philosophies have synced. And they, as they were scaling, they could use somebody like me with my skill set, right, of finance. They have other skill sets, so we have complementary skill sets. So it just worked out that we feel like we make a stronger team and be involved. And I want to get involved. And so that's kind of what we're doing, right? So I just kind of I still do an LP investing, right? But
yeah,
now I'm focusing a lot more on general partner activity. We're finding acquisitions, we're raising capital, and we're operating these assets in mostly Greenville, South Carolina, but we're open to the Carolinas essentially as our target market.